Hi, everyone. I'm just going to do a brief video regarding Chapter 5. I'm going to do Chapter 5 and Chapter 6 separately, only because I think it'll be way too long a video and you'll start to lose attention. So let me share my screen, go over Chapter 5. So I'm just going to go over some journal entries for the perpetual and then later the periodic inventory system. That's the first thing I'm going to do. But before I do this, you're going to see this. I have this attachment in this discussion. I would suggest, because there's 9 of them, I would suggest you try doing these all on your own, just on a piece of paper, and then come back and look at the way they were done, just to see if you did them correctly. And if you didn't, you're going to learn more by trying to do it yourself and then coming back than just listening to me and doing it. So, and there's something about writing it down on a piece of paper that for some reason helps you to remember things also. So, and I'm going to do T accounts, but just for some of them, because I don't want to get all involved in the T accounts. I'm just doing the T accounts where we have some balance adjustments. So if you're do this on your own, stop the Zoom right now, do it on your own, and then come back and see what the solutions were. First thing, and we're doing perpetual inventory first. First item is Jack purchases inventory from C company, or Jake, I'm sorry, in the amount of $2,000 on account. The terms are 210 net 30. So first thing I'm going to do is I'm going to debit inventory and I'm going to credit accounts payable for that $2,000. Next thing is Jake pays the freight charges of $100 in cash for the goods purchased. They were purchased FOB shipping point, which means the purchaser or buyer is responsible for the shipping charges. So of course he's paying that in cash. So the way we're going to account for that, we're going to debit inventory again for that amount, that $100, that increases our inventory. We are going to credit cash for $100. That's how we paid for it. I am going to share the T account. You're going to see all of it, but I'm just going to share the T account right now, just so you can see the inventory at this point in time. So if you look at the inventory, and I just kind of put them in different orders, you'll see that 2,000 purchase first, and then that additional debit of the $100. Okay, let me go back. Okay, next item. On the 3rd, Jake returned 200 of the inventory purchased on February 1st. So Jake is going to debit accounts payable. We no longer owe 2,000, right? 200 of it has been returned. So at this point, if we looked at the T account, I don't think I'm going back there, but if we looked at the T account, it would be 2,000 minus the 200, right? You'd have a 2,000 credit and a 200 debit in accounts payable. We're going to also decrease the inventory. We no longer have that inventory. So we're going to decrease or credit inventory by that 200. Next one, Jake company paid for the merchandise purchased on February 1st, taking advantage of the discount. So if you look at this, we've got to get rid of our accounts payable. So let me show you, I think I'm going to show you the, let me show you the accounts payable right now. So if we look at this T account and we look at our accounts payable, remember it was 2,000, but now we debited 200 at this point. So at this point, we owe 1,800. We need to get rid of this accounts payable. We no longer owe it. So we're going to debit accounts payable for that 1,800, and our balance is now 0. So let me go back. So we're debiting accounts payable for that 1,800. As far as the cash we're paying, we're getting a discount, right? So if you go back, it tells us the discount was a 2% discount. So if you multiply 1,800 by 98%, because 100% minus 200, or excuse me, 100% minus 2% is 98%, you're going to owe cash of $1,764. So that's what I'm crediting cash for here. We're going to also decrease the inventory because we got a discount. We have to credit inventory. So 2% of 1,800 is $36. So we're going to go ahead and credit inventory for the $36. Okay, what we're going to then, and what we're going to then do in the next steps, February 5th, we are selling inventory. The inventory we're selling costs $1,600. We're selling it to H Company in the amount of $2,800, and it is a credit sale. So it's going to be an account receivable. The merchandise was sold FOB destination, which means the seller must pay the freight costs, and J Company pays $50 for the shipping costs. The terms are again $210 net $30. So if we go to the 5th, remember we're doing perpetual. We're going to have two entries. First thing we're going to do is record the sale. That's going to be debiting accounts receivable for $2,800, crediting sales for $2,800. Then we're going to go ahead and account for the cost. So the cost of the goods sold, the cost of that to the company was $1,600, and we're going to debit that and credit inventory for that $1,600. We also have to pay our freight out, right? We were told freight out was $50, so we're going to debit that. And then this cash, we're going to credit because we're paying it with cash. Next item, H Company returns 100 of the merchandise to Jake. So H Company, for some reason, returned that merchandise. It wasn't damaged. The cost of the merchandise that was returned to Jake was $57. So if we look at the 6th, we're going to have a sale return and allowance for 100, right? That's going to be our contra account to sales. And we're going to credit accounts receivable for 100. They no longer owe us that $100. Those goods were returned. When we look at the inventory, we're going to increase that by 57. That was the cost, $57. We're going to increase our inventory. It's back in inventory. This is no longer an expense. It's no longer a cost of goods sold. So what we have to do is we have to credit cost of goods sold for that $57. Next item, on February 7th, Jake receives payment from H. H Company took advantage of the sales discount. They paid it within a timely manner. So let's just go look and see what that account receivable is right now. So let me stop my share and look at the T account. And if you look at that T account, if you check out that T account, you look at accounts receivable, it was $2,800. $100 was returned. So what we're going to have to do is credit that for $2,700 because the balance should now be zero. They don't owe us that receivable anymore. So we're going to go ahead and we're going to credit accounts receivable for $2,700. If you look back to the practice, I'm going to show you that entry. So here we are. We have sorry, let me go back down a little bit more. We're going to receive cash for $2,646. That's that $2,700 times 98%, because if you look at it, it was a 2% discount. 100% minus 2% is 98%. So that's the cash we're going to receive, $2,646. The sales discount, again, that's a contra account to sales. The sales discount would be 2% of that $2,700. 2% of $2,700 would be $54. And we're then going to credit accounts receivable for what would have been the balance in that accounts receivable account, $2,700. Okay, looking back, number 8. On December 31st, Jake took a physical count of its inventory and it discovered actual merchandise inventory at year end was 291. So let's go look at our inventory count and see what it is at this point in time. So let me share my screen and show you those T accounts. So if we look at the inventory account right now, we had we had all these adjustments. So if we look at it right now, it would be valued at $321. Well, it's not, right? The balance should be $291. So what we're going to have to do is we're going to have to credit inventory for that 30. We're going to have to debit cost of goods sold for the 30. So let me show you what that looks like in the journal entry. So what we're doing right here, we're doing our adjusting entry, debiting cost of goods sold for that 30, crediting inventory for that 30. And that's in order, that adjustment is in order to reflect the correct amount of inventory. So I then created an income statement, the multi-step income statement. If you look, I can trace most of this without even going to the T account. Sales revenue was 2,800. That was back here. And then we had that sale return and allowance. Remember, they returned $100, which is here. And then we have that sales discount of $54 when they paid it, which was right here. So if we add the 154 together, it's 154. So the net sales is the 2,800 minus the 154. It is 2,646. Next, we have our cost of goods sold. So if we look at that cost of goods sold account, let me show you that really quick. And you might want to keep T accounts just for, the few accounts where there's a lot of changes. But if you look at that cost of goods sold account, remember at one time it was 1,600. That was reduced by 57. We had to increase it by 30 when we looked at the inventory, and it was worth 291. So the balance is $1,573. So let me stop my share. Hopefully these numbers are all correct. I made this all up, so let's hope I didn't make any mistakes. But that's right there, my cost of goods sold, 1,573. 2,646 minus 1,573 is $1,073. We have one operating expense, that was our freight out, which was back here for $50. So if we look at our total operating expenses, that's 50, 1,073 minus 50 is 1,023. For our closing entries, we're going to close revenue, right, to income summary. So we're going to debit sales revenue to get rid of that account, credit income summary. We're then going to close all our various expense accounts, and we're going to debit income summary for that total and then credit each individual account. So we get rid of each individual expense account, and our sales return and allowance and sales discount accounts. We're going to close all of those by crediting them because all four of those accounts normally have a debit balance. We would take that total and close income summary out for that total. We then need to close income summary. So to do that, since at this point we would have a credit balance in income summary, 2,800 minus 1,777 is 1,023. We're going to debit income summary and we're going to credit Jake Company Capital for that 1,023. I did do some the periodic inventory. I don't think we work with it at all. Not that I remember, at least for homework problems. And I just wanted to show you some of the differences. So for example, on February 1st, if we go all the way back to the 1st, we had J Company purchases inventory from C Company for $2,000 on account. Remember, under perpetual, we debited inventory, credited accounts payable. It's different under periodic. Under periodic, we are debiting an account called purchases and crediting accounts payable for the 2,000. Under the second item where where Jake paid the freight charges of 100, under perpetual, we debited inventory, credited cash. We're going to debit a different account under periodic. Under periodic, if you look at this, we're debiting an account called freight in, still crediting cash, of course. In the February 3rd entry, Jake returned 200 of the inventory purchased on February 1st. Under the perpetual inventory method, remember we debited accounts payable and credited inventory. That's going to be different. What we're going to do, we're going to still, of course, debit accounts payable, but now we're going to credit an account called purchase returns and allowances. Okay. Fourth item, what we did in the fourth item, Jake Company paid C for the merchandise purchased on February 1st, taking advantage of the discount. So for perpetual, we debited accounts payable, credited cash and inventory. For the periodic, we're still debiting accounts payable, but we're crediting an account called purchase discounts. And then, of course, crediting cash, but it's a different account name. Let's see, fifth item, Jake sold inventory that cost $1,600 to H as a credit sale in the amount of $2,800. And they also had to pay a $50 shipping cost. So if you look at what we did in the fifth entry, we had two entries, right? One to account for the sale, one to account for the cost. If you look at the periodic, that fifth item, we're not accounting for the cost here. The only item that we're accounting for right now is for the account receivable and the sales revenue. We do, of course, account for the freight out also. Let's see, sixth item. H returns 100 of merchandise to Jake. It's not damaged. Cost of the inventory was $57. And the perpetual inventory system, what we did there was we had sorry, just lost track. I'm sorry, here we go. We had a sale return and allowance, and then a debit and accounts receivable credit. And then we also had account for the inventory, where we debited inventory, credited cost of goods sold. If you look at the periodic, we're just debiting sales return and allowances and crediting accounts receivable. And then the last item, number 7. I think I gave it to you, but I think it's the same entry. Debiting cash, debiting sales discounts, crediting accounts receivable. But it's basically the same. If you look at periodic and you look at the perpetual, they're the same. Debiting cash, $26.46, debiting sales discounts, $54, and then crediting accounts receivable, $2,700. I didn't go any further. I just wanted to give you a brief example just to show you some of the differences you're going to see between perpetual and periodic. Have a good week, everybody. I will make a recording for the chapter 6, but it will be a separate recording. Bye, everybody.